Thank you for tuning in. I am your host, Joseph Martin. Hit that like and subscribe button to support the channel and hit that bell icon to receive notifications. For a beginner, investing in the stock market can be extremely intimidating. One reason is that even though you know there's an opportunity you can make money, the idea of losing money seems more of a guarantee. In biblical terms, losing money looks like Goliath and making money looks like Jacob. Here's the good news. If you don't know what you're doing, the chances are extremely likely, almost a guarantee, you're going to lose money. So you're right to feel that way because this is your subconscious telling you, now you don't know what you're doing. When everyone was looking at the size difference between David and Goliath, what they couldn't see was how skilled David was with a sling and a stone. David's weapon could be used at a distance, but Goliath's sword needed to be used in close range unless he planned on throwing it at David. Goliath's size could have been viewed as an advantage, but I would argue it wasn't. His size made him slow and a target that was so big, he would be hard to miss. What does all this have to do with choosing stocks in the stock market? I'm glad you asked. You need to learn how to recognize an opportunity or what gives you an edge to make money on your investment. That story was to show you that sometimes it's not about the challenge itself, but more about how skilled you are to handle that challenge and how you look at it. Before we get started, this isn't financial advice. Read the disclaimer in the description. So let's dive into it. Lesson number 1, study the greats. It might be your first time investing in the stock market, but you aren't the first person to invest in the stock market. You want to use this to your advantage. The way you do this is by learning from other people who have had success before you. One of the greats that I've studied is Peter Lynch. Peter Lynch invested in Taco Bell and saw it as a huge opportunity early. So much so, even when the stock price was falling and he was losing money on the investment, everyone thought he was crazy. But he saw the lower price as more of a bargain and kept buying. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990. Over those 13 years, he grew the fund's assets from 18 million to over $14 billion, averaging nearly a 30% annual return. Studying the greats is the simple philosophy of, if you want to be the best, study the best and do what the best do. What makes Peter Lynch an easy study is that he's written 3 books sharing his ideas and what he sees as opportunities. Those books are One Up on Wall Street, Beating the Street, and Learn to Earn. Lesson number 2, think long term. We discussed this in the first video, how to start investing in the stock market, but I feel this is something we need to go over again. Investing is not the same as trading, and this isn't a strategy to get rich quick. Your mindset should be, before you invest in any company, is that you're going to hold this stock for longer than a year. You're not likely to start your investing journey off with thousands of dollars. So the investment that you choose is going to be one that you continue to invest in over time. The investment term for this is called DCA, dollar cost averaging. This is a strategy used by funds and people investing millions, if not billions of dollars. So traditionally, it was defined as starting off with a large amount of money and spreading it out over a period of time to purchase shares instead of buying them all at once. Now that more people who aren't managing large amounts of money are investing in the stock market, the definition has become more relaxed. As long as you're using a disciplined strategy of buying shares on a schedule in the same stock, you're dollar cost averaging. This is exactly how I was able to get over a 70% return using the DCA strategy, buying shares every week in Netflix. Lesson number 3, focus on growth. We've covered DCA. Now let's discuss 2 more investing terms, principal and ROI, return on investment. Principal is the money you put into an investment when you invest. Your goal is to never lose your principal, but this is what happens if you get a negative ROI. If you do get a positive return on investment, this is the amount of money or value that you grew on top of your principal, the money that you started with. This is going to be a simple, common sense strategy to help you find opportunities in stocks to double your investment. Let's start with some questions. Is McDonald's a great business? Yes. Do you think you can double the money you invest in their stock in the next few years? Instead of answering that question directly, I'm going to give you a simple principle to follow. Your investment or principal grows with the business. Is McDonald's an international company? Yes. This means it's already grown to reach all over the world. Does that business have room on earth to double again? No. So it's not about McDonald's being a great business. It's about the business having room to grow or expand its business. Well, if that's the case, why does anybody invest in McDonald's knowing it doesn't have much more room to grow? I'm glad you asked. Because they pay dividends. Dividends are payments made to stockholders based on the number of shares they own. This gives investors an opportunity to get an ROI without having to sell their shares. Public traded companies that have maximized their physical growth potential usually start to offer dividends to attract a different type of investor. This type of investor is more focused on a stable and consistent income versus growth on the principal. Since we're discussing dividends, I'll give you a bonus that beginner traders and investors often fall for and lose their principal. Dividends are a tool or a strategy used by public traded companies to attract investors. It's for them. It's not for you. The stock price falls by the dividend payout. For example, if McDonald's share price is $300 and they pay you a $3 dividend for owning that share, the stock price changes from $300 to $297. So basically, they're giving you a portion of your stock value. What if you bought it for $300? That's a horrible trade. If I give McDonald's $300 and they give me $3, and if I want my $300 back, I only get $297. Guys, focus on growth. The amount of the dividend payments are not, and I repeat, not a sign or indication that it's a good investment. So this means bad companies, which would also be bad investments, offer high dividend rates to attract investors because their business itself doesn't attract investors. Lesson number 4. There are 2 types of growth. This is going to be the shortest lesson of everything we've gone over so far because we're going to address the 2 types of growth separately. The first type of growth is physical, and the second type is opportunity. Lesson number 5, physical growth. Going back to our McDonald's example, the business started off as a single restaurant. From there, it grew. It became more restaurants, and those locations expanded and expanded. The business is showing one of the types of growth we're looking for. For instance, they went from being in one city to multiple cities and counties, then from one state to multiple states, regional, national, and international. Lesson number 6, opportunity growth. This type of growth is the most powerful because it has unlimited potential. With physical growth, the business is limited by how much it can physically expand and remain profitable. There's nothing different about the McDonald's business itself. It's the same goods and or services. But opportunity growth is when the business grows by either buying other businesses or expanding the goods and services they offer. The best businesses do all of these. Amazon is the greatest business I can think of that does this. The investment term for buying other businesses is called mergers and acquisitions, and offering more goods and services would be as simple as being innovative and expanding into other markets. Now that you have a deeper understanding that there are 2 different types of growth, you wouldn't miss an opportunity of investing in a company such as Amazon. Though Amazon has maximized its physical growth, currently they do not pay dividends. This is because Amazon remains active in opportunity growth. Lesson number 7, follow the customers. Let's revisit one of the greatest investors of all time, Peter Lynch. He has a simple philosophy for picking stocks: invest in what you know. The most honest and dependable customer you'll ever find is yourself. The businesses you purchase goods and services from make you a customer of theirs. And if you only buy those goods and services from them, you're a loyal customer. This is a simple yet powerful tool you can use to get into the heads of loyal customers by being one of them. What makes their goods and services so great that you only want to do business with them? Chances are they have other customers that feel the same way you do. Here's another philosophy you can add to your investing toolbox. A business is only as good as its customers. The more customers a business has, and the more those customers wants to spend money with that business, the more that business can count on that revenue. Netflix, Amazon, and Wingstop were the best investments I've made money on and missed making money on by using and not by using Peter Lynch's advice. For the sake of not making this video any longer than it already is, I'll share with you my experience investing in Wingstop. They first got my attention because I was seeing them pop up everywhere around Michigan cities. And in Rick Ross's book, The Perfect Day to Boss Up, in chapter 11 titled Your Bedroom is Your Office, he mentions he was the proud owner of 25 Wingstops. I understood the physical growth concept thinking about what I learned from Peter Lynch and his Taco Bell investment with restaurants expanding geographically. One of the things Lynch does as he uses the investing in what you know strategy is to visit locations of the business, basically investigate. The first thing that I noticed about Wingstop was that they were popping up everywhere, but the parking lots always seemed to be thin or empty. Looking back on it, I missed the fact that none of them had a drive-through, which would be an opportunity growth if they added it. While I was running errands, I pulled over at one of their locations and went inside. First thing I noticed was that it was clean and that they had one person working behind the counter. The guy had excellent customer service because he had a positive attitude and explained things to me when I told him it was my first time at Wingstop. After I got my food and went to the drink fountain to get my drink, I sat down, slowly ate, and paid attention. The food was delicious. So I'm like, that's on point. But where is their money coming from if there isn't a lot of people dining in? Remember, I'm not basing this off of one Wingstop. I never saw any locations where the parking lot was packed. Then it happened. One right after the other, Uber Eats and DoorDash drivers kept coming in to pick up orders. That's why the parking lot isn't busy, because the majority of their business comes from food delivery and carryout. The best way to find businesses to invest in is to educate yourself on how to recognize opportunities, which is something that I've talked about before. If you want to find something, first make sure you know what it looks like. You already know. I hope that you learned something, and I hope that you earned something. Hit that like button and put your thoughts down in the comments. Let me know what you guys think. Make sure you check out the other 2 channels, Original Greatness Uncut and Original Greatness Shorts. If you want to know the 4 skills you need to develop to maximize your chances of making money off an opportunity, check out this next video. Take care and God bless.